Hello everyone. There are decades when nothing happens, and then there are weeks when decades happen. We at Franklin Templeton couldn't agree more with this quote from Lenin. But our management team strongly believes that assets are managed in good times and relationships in tough times. And that's why we're here today to address each one of you who invested your faith and trust in us as a brand, to reach out to you to answer all your queries and concerns that you've been having on social media, on email, at the call center. And we have none other than the president of Franklin Templeton India, Sanjay Sapre, to answer these queries for you. Hi, Sanjay. One of the most popular queries that we had was that it was a roller coaster ride for equity and debt investors. How it differs across asset classes and how do investors cope with this?
So good morning, Gitanjali, and good morning, everyone. So I think it's quite interesting. This is a time when we've seen volatility in both equity and debt markets. Now, when it comes to equity markets, I think it's a lot easier for investors to understand that the market moves up and down, and therefore they see volatility in their returns and they see the NAV of the funds go up and down. But when we talk about fixed income, I think to start with, the word fixed itself causes confusion to investors because it gives people some sort of an assumption of safety. And while it's true that over long periods of time in history, debt funds have been less volatile and have been safer than equity funds, it doesn't mean that debt funds come without any level of risk. So typically in a debt fund, investors may experience a credit risk, which is the risk that a company that has been invested into may go through challenging circumstances and may not be able to pay its debts on time. Or you could even have liquidity risk, that you don't have the level of flows that you would like in the funds. Or you can have interest rate risk. And this interest rate risk can actually cause, with nothing changing in the fundamentals of the company or the paper you've invested in or the debt you've invested in, this is like the equity market moving up and down. Interest rates moving up and down in the economy can cause valuation gains or losses for investors. And I think it's quite hard for investors to understand that. Now, for long periods of time in debt, this risk may have seemed theoretical to investors. But all of these risks tend to become real in challenging circumstances like we're seeing today. And I think those risks becoming real, causing valuation losses for investors in their holdings, that is what is causing investors a significant amount of concern. What investors have to remember is that in any asset class, whether it is equity, whether it is debt, a higher level of return or a higher potential level of return will always be accompanied by a commensurate higher level of risk that may become evident. And therefore, it's important that investors understand those risks and understand that in challenging circumstances, these risks will play out, and therefore make the decisions in terms of staying invested or otherwise, in terms of their risk appetite, their understanding of the risk, and not act in haste or panic. One other thing that investors should remember is something we've learned over many long periods of history, and that is that markets operate in cycles. Therefore, it is safe for investors to assume that this challenging environment that we're seeing today and this volatility that we're seeing today will not persist forever.
Sanjay, we had another question which was popular, that the fixed income space has been challenged for the last 18 months across the industry, where we've seen markdowns, portfolio segregations, including in, Yes Bank and Vodafone. We would like to hear a comment from you on that in terms of what it means for the industry and for us specifically at Franklin Templeton.
Starting in, I would say about late 2018, when we first saw, the beginning of the crisis with the ILFS issue, I think the industry has seen a very, very challenging time, probably more challenging than at any point of time than I have seen in the history of credit markets in India. The ILFS crisis, then we shortly saw after that the NBFC issues, then we saw stress in some sectors such as telecom, we saw stress in some sectors such as infrastructure, and that resulted in a large amount of rating downgrades, large amount of or some defaults, and as you said, some segregation of portfolios. And I think it's important for investors to remember that some of these issues actually started in higher rated papers. One always assumes that, for example, a single A rated paper is very risky. And of course, that rating does signify a higher level of risk in general. But many of these issues actually started in AAA and AA rated papers itself, which was also, I think, more challenging for investors in terms of being able to understand that. From a Franklin Templeton perspective, I think we actually navigated that initial environment very well. So if you look at the period from September 2018 till late 2019, there were many names that were stressed or had issues. Some that come to mind just off the top of the head besides ILFS is, for example, an Altico or a Simplex or a Syntex or an Adilink and many others. And we actually had no exposure to any of those names. Sure. Absolutely no exposure to those names. In fact, a couple of, I would say, early stressed exposures where we had some, or names where we had some exposure, Yes Capital and WGC. Both of those we actually exited either early or on time and without any losses. I think the challenge for Franklin Templeton specifically has been that starting from late 2019, we've had 4 issues in short succession. And the combination of 4 issues in short succession has caused value erosion for investors. So investors are seeing a value erosion in those portfolios, and that's what is causing investors significant concern. So you mentioned 2. So in the case of Vodafone and Yes, we had to create segregated portfolios. And in the case of SL and ADAG, we had to take mark-to-market valuations. And I think that is what has caused the concern. I do want to reiterate that we have not, so despite the segregation and despite the valuation markdowns, we have not written off permanently, which means we have not said that it is our endeavor to recover anything other than the full value that is owed to us.
The next question that most of you had, what is your advice to all those who have invested in the managed credit space?
So I think that's a difficult question, Gitanjali, because each investor has a unique set of circumstances. So it really depends on someone's risk appetite, their need for liquidity, their ability to withstand volatility in this space. It is often said, it's kind of an adage, right, that you find the best opportunities in volatile times. This is said about equity markets quite often, but interestingly, it's also true about credit markets. So today we have a challenged environment. The environment has gotten significantly more challenged recently because of the whole coronavirus outbreak, which is causing a lot of concern for investors and the impact it will have on the economy and on companies. But what that environment is doing is allowing us to find good yields and the ability to deploy money at higher yields. Now, obviously, a challenging environment gives you this opportunity of higher yield, but it also brings a potential of elevated risk for companies operating in this environment. So I think it's important for investors to balance these two things and say, do I want or do I feel able to withstand some of the volatility? And do I understand that that might lead to a better outcome in the long term if there are no more credit issues and the situation is managed well? Or do I want to move towards safety? So that's the first thing investors need to consider. I think the second thing investors need to understand when being invested in debt funds is this whole concept of fair valuation. I mentioned it a little bit earlier. I want to spend a minute on fair valuation because I think it's a concept that investors find quite difficult to understand. See, the funds are open-ended funds. That means investors can redeem or purchase every single day, which means the NAV that is struck at the end of the day, the net asset value, must reflect the appropriate value at which investors are allowed to purchase or investors are allowed to redeem the fund. If there is a fundamental change that we believe impacts the valuation of one of the positions we are holding, then it becomes incumbent on us to do a fair valuation. We did 2 recent fair valuations. One was in ADAG, one was in SL. If you look at these, there were a number of protections and covenants around it. But one of the things we also had was the security of some listed shares. These companies were also trying to do asset monetization in order to repay all of their debt. When the environment became very challenged, we've seen the market collapse from, broadly 43,000 as the Sensex value down to maybe 32,000 in a very brief period of time. One is obviously asset monetization is delayed because the environment is not conducive for selling assets. Second is that the value of the liquid shares you're holding has also been impacted. In that situation, it becomes incumbent on us to recognize that stress and fair value the asset. What happens there is actually fair valuation protects investors who are staying because investors who are leaving don't take away value that may not be realizable in the portfolio today. But it actually comes across to investors that it's negative for someone who stayed because they've seen the mark-to-market loss. We should know that a fair valuation is a point-in-time assessment. right? Not a permanent write down of any of our debt obligations. As I said, we continue to strive towards full recovery in all cases in our portfolio. So you asked me, what do investors do in managed credit? Sorry, I went, a little bit to explain that. But I would say, don't act in haste or panic. Understand the tax implications, understand the exit load implications, think about your own risk appetite and your ability to withstand maybe some potential volatility. Understand that the longer one stays in a managed credit strategy, generally the better outcome one should expect from that strategy. And then on a combination of all those factors, make your own decision. But I urge people not to act in haste or panic. That's generally never the best decision.
We've seen a lot of online chatter on the fixed income strategy and, how we've probably made some changes to it in the last 3 months to 6 months. So would you want to address this question for the investors?
Sure. So, first of all, I understand why the concerns are being raised. They're being driven largely by the recent issues that we've had in terms of performance. But I want to assure people that nothing has fundamentally, in that sense, changed or gone wrong with the fixed income strategy. We've always followed a disciplined, rigorous approach to investing in the fixed income space, and we continue to follow that approach. I think what has happened is, I talked earlier about the potential risk in the credit strategies and the challenging environment, which has meant that all of these risks have come together, and they've come together in short order. And that is what is heightening the concerns. But we recognize the risk in these portfolios, which is why we offer two kinds of funds. We have savings fund, banking PSU, corporate debt. You will not find too many mark-to-market or other kind of events in these funds. No segregations, no markdowns in these funds. But the yield is correspondingly lower. On the managed credit space, we've always believed in the power of that space to offer higher yields for investors who understand the commensurate level of risk. And we continue to believe in the power of those strategies to deliver meaningful outcomes for customers over the long term. What we do is we do learn from every one of these incidences and situations to try and continuously evolve and improve our processes.
Last week, some of you actually experienced some operational challenges and servicing related issues. Sanjay, we just want to ask you, have the issues been resolved permanently, and what's the status as of today?
So unfortunately, we had some issues, and those issues caused a lot of rumors and concern about was there something going wrong at Franklin Templeton. Let me assure you that is not the case. The first issue we had was, unfortunately, some redemptions for investors got delayed. So not all, a small number of transactions failed in our end of day batch due to a technology issue. And I think our biggest problem was we weren't proactive to let investors know. So on the same day, the transactions did get processed and the money did get paid out. But we weren't proactive. So there was a period of time where investors were not hearing from us. And I think that is what caused concern. On the same day, unfortunately, we had an issue where our website had some access issues, even though the mobile app was working well. And that added to the concern. But it was actually a completely separate and unrelated issue. So there are no significant issues in the systems or any cause for concern. In any technology, there is always the possibility for some issues to crop up. I think what we need to do far better, and what we're committed to doing, is actually to proactively communicate to investors and let them know, and to distribution partners, to let them know if there's an issue, so that they're reassured that we're working on it and we're going to take care of it.
Some of you have also raised concerns on the equity fund performance. Sanjay, would you like to share your thoughts on this?
So if you look at our equity funds, I think our biggest problems have actually been in the large cap space. So if you look at our mid-cap fund, our small-cap fund, maybe our focused fund or our thematic infrastructure fund, these have done reasonably better. We've also seen a lot of interest in our US opportunities fund. So the issues have largely been concentrated in our large-cap allocations. And that's been a relatively interesting space for the last couple of years. The market, even when it reached the kind of dizzying heights of 42,000 for the Sensex, that market was largely driven by a handful of stocks. It was a very, what we call a narrow market. And the absence of some of these names that did extremely well in our portfolios, maybe for good reason, right? That has really impacted our performance. And in our opinion, the market was largely driven by liquidity and momentum, which means through a re-rating, and not necessarily by earnings growth of the companies. We are what I would call a growth at a reasonable price manager, which means that we want to buy into growth, but we want to buy into growth at a reasonable price. It's not that we would want to pay any price for growth. And that strategy has not been in favor in this narrow liquidity/momentum driven market for us. Just what has happened in the last few days has taken the market back from a peak or a near peak to 3 years back. So almost 3 years gains have been wiped out in this market. However, I think with this market correction, it gives opportunities for managers like us. And hopefully as the market comes out of this cycle, and as I said before, markets do operate in cycles, then the market will reward the inherent quality that is existing in our large cap portfolios and allow our performance to improve. I think it's important for investors to remember that winners rotate, and that's not a cliche. So if one goes back and looks in data, one will find that the funds that are doing the best today are not necessarily the funds that were doing the best 2 years ago. And therefore, funds that may appear challenged today because of a market environment may not necessarily remain challenged forever in the future. And I think it's important to remember that in investing.
How is Franklin Templeton coping with the coronavirus outbreak? We would like to have your thoughts on this, Sanjay.
So obviously that's an emerging threat that we need to be very conscious of. And for us, what's very important is the safety and health of our employees. Fortunately, we have a very well-tested BCP. So we test our business continuity plans every year. So in dealing with coronavirus, obviously we are seeing increasing restrictions being placed by various states themselves. But from our own response perspective, there are two strategies that we adopt. One is anybody who can work at home is being allowed to or enabled to work from home, which helps with the social distancing. And for anybody who cannot work from home, we are creating what we call clean teams or split teams. So people are split into teams, and those clean teams do not come into contact with each other, either in the office or socially, to minimize the risk of cross-infection. So that's how we are trying to protect our employees. For our investors and distribution partners to access us, because we recognize that they may also be uncomfortable coming into offices, taking public transport or being out in public. What I think is good is over the past few years, we've developed a robust suite of online capabilities. So almost anything that an investor or an advisor could do by coming into our office, they can now do through a combination of our mobile app or our website or our other online tools. Of course, our branches remain open should someone want to come in. Our call center and other service touchpoints also remain open should someone want to come in. But there we are taking heightened precautions around hygiene, sanitization, assessing the history of visitors who are coming to our office, etc., to try and minimize the spread of this terrible disease. And while we've taken all of these steps, I think it's important to remember that this is an emerging and ever-evolving situation. And therefore, if we need to take additional steps in the future in order to protect the safety and health of our employees, then we will take those in the future as the situation evolves.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.